Hello everyone. Before I go any further into the video, I want to just make it clear from the start that this is simply a request from somebody to make this video. It's not my goal to make this video for everybody, and this is what you have to follow. This is just my opinion, and of course, I'm not the author of these concepts, and the better person to ask these questions to would always be ICT. But this question was asked to me, and so I'm just going to give my opinion on it. But I will always, redirect everything back to ICT when the opportunity is there. So, anyways, the question was, how could he find more success on the lower time frame? Because he's having trouble finding success underneath the 5 minute time frame. Okay, and I want to say that you don't need to use the 1 minute chart to be profitable. It really depends on what you're comfortable with. The time. If 1 minute chart is too fast for you, maybe you don't want to use 1 minute chart. Maybe you want to stick on 5 minute chart. And you, as long as you know where price is going on whatever time frame, you have a basis to take a trade on, and which the tools you want to use to reach that draw, it may change, and the time frames you use, may change. So I'm not saying that 1 minute is the answer. I don't believe that. But on large part, if you have trouble reading those 1 minute price fluctuations, in my opinion, I believe it stems from an infancy in being able to read price action. Now, you can understand how it moves in 1 minute and still choose not to trade the 1 minute. I'm not saying that 1 minute is the key. No, that's not what I'm saying. But I'm going to explain, I guess the way I look at charts and this idea about how, you don't need the 1 minute chart. But to understand, what price is doing, you shouldn't have a problem with looking at a 1 minute chart compared to a 15-minute chart. It's just about what you're comfortable with, with the terms of what's easier for you to look at, what's easier for you to get you into a trade, and that's what I'll talk about. Alright, so without further ado, I want to use Wednesday, and I'll talk about Tuesday too, as sort of, explaining this idea, how you can use, all the time frames to line up. And again, the main idea is that if you're able to look at every single time frame from the 15-second chart, to the daily chart, you are going to find the deepest connect with price. And that's really how you study price. When I look for an entry in something to buy or sell, my success, I guess would say, is mainly stems from the 15-minute chart. I wait for the 15-minute to show me something that the next 15-minute candle is going to displace and sort of reverse, and then I go on the lower time frame to try and line up with it. But that idea that the 15-minute chart should turn at a certain point is sometimes, not always, stemmed from where the daily chart is going. Sometimes it's where the session is going, but there's this higher idea of bias and where is the draw, and it all really stems from at the beginning of the week, where I think the weekly chart will go and the daily chart will go. So actually, maybe it'd be a good idea to start with the weekly chart first. Oh wow, I forgot I made a mistake. I have to fix that. But obviously, you look at the weekly chart at the beginning of the week, and you see this large wick closing higher. This does not look good, right? Because even though we have a bearish fair value gap and we had an immediate rebalance, we've already moved so far away and basically had a sell side draw to the rejection block that we've already sort of done what we need to do lower. And so I'm saying that, I'm keeping an eye on that SIBI formed, and if we trade up in it, I would rather not see this fill in. But the large wick up a closed candle has left me unsure. And so I'm basically saying, okay, well, if we are going to continue going lower, I wouldn't want this to fill. If it starts to fill, I wouldn't be too excited about going lower. Obviously the daily chart, you can see a large engulfing candle with trading the low and the high of the last 2 days. And so the obvious order flow is higher, right? And so as we see the week day by day trading higher, shorts are not very attractive, but longs are not very attractive either, because we're so overextended. And that's one of the reasons I've been doing less this week, and I've been studying price more. But Wednesday was not a bad day, because we were actually given a good retracement, which is why I want to talk about Wednesday. We had a nice market maker buy model. So I get up Wednesday, and obviously it's the same old thing. It's the order flow is bullish. I'd expect today to draw higher, and then we had the CPI news release, which kind of fluctuated up and down, and left this range, which at 9:30 we hit the high end of it, and then we dig below this low, the low end of it. I waited until we hit a 15-minute level. So let me go to that day. See how we had that retracement. So we were in an area of discount. We had a 15-minute gap, and the gap, where it reached wasn't so important to me. It's just the idea that we were in a discount, that we retraced, and that we had this short-term run on stop. So you see how here I'm using the 5-minute chart to qualify a 5-minute bullish breaker, which stopped out anyone buying early, and then we went to stop out anyone that was selling throughout the morning. Okay, and this is a really nice move up, but just knowing the draw up to these highs, and then how price is going to reverse here, you can find another trade idea once we get above these highs and you see price start to invalidate some of these fair value gaps and create inverse fair value gaps. That's a trade idea within itself. So you can go on lower time frame, and you know that any bearish fair value gap is going to have a high probability of working. You can go to the 15-second chart in these candles and find something with a bearish fair value gap that's high probability of working. And then if you know that as we grab the short-term low and form this breaker down here, you know the turtle soup is high probability. You can go to the 15-second chart down here, you can find something that's high probability of working. So maybe we can actually go ahead and do that. So go to the charts. Let me switch it over here. So we're gonna go back to Wednesday. I don't know if it will let me. Yeah, it will let me. Okay, so we're gonna go to the time where we reversed, and so if you have that in mind, that as soon as we grab this low, immediately you know that the order flow has now changed to being bullish, and so you're gonna be looking for longs, as immediately as this is changing and now starting to trade higher. So where are any bullish fair value gaps down here? There are none, and you start to see one. Okay, well, this one doesn't even get traded too. This one works, this one works, this one works, and then how many of them fail? None. There's none that fail until we really start to displace to the point where it'd be unreasonable or you need to wait for another manipulation before longing, right? But if you try to long these gaps, why wouldn't it have worked? Because you're not waiting for the manipulation. So this is why you need to look at different time frames. You can't just look at one time frame. If I just use the 1 hour chart, and that's the only thing I used, I wouldn't be able to find success. Or, well, I could find success, I'm sure, with a good risk management, but I wouldn't be precise on knowing exactly when price is going to move. Not precise as in my trades are precise, but as in my bias is precise. My timing is precise. I know when price is going to move at what time. You need to use different time frames and line up with a bias in order to know that. Just looking at one time frame isn't enough to place trades on. I mean, I could look at one time frame and have a bias, I guess, and have an idea of where it's going to go. But to be able to be precise on, the time it's going to do it and where it's going to manipulate and reverse, you can't just look at one time frame and be able to know that. You need to combine different time frames. So thinking, over here at 10 o'clock, is this gap going to work? Well, where's the manipulation? Right? Go and look at a higher time frame. Go back at this point before we trade into this gap and start looking at it from different time frames. Okay, would you feel comfortable longing on the 1 minute chart here? What about the 5 minute chart? No. Why? Because we didn't take this liquidity down here. And we have a bearish fair value gap which we're trading into. So immediately, anything under the 5 minute, if you see a bullish fair value gap, it's probably better to inverse it. So let's try and inverse it. So we see that, okay, when bearish fair value gaps, do they work well? We don't. Yeah, we trade into this small one there. It works very nicely. We inverse that one. Continues to work. And so you immediately there you have better. You had a 1 minute institutional overflow entry drill. This is a trade that ICT called out because he was able to understand that the order flow was going to go and drive price lower. So once we took out this low, what are you waiting for? You're waiting for an initial attempt to go higher to get people into longs, right? So this isn't convincing enough, but you're waiting for something that's convincing longs. So you have a couple of fair value gaps, and you have price which kind of meanders around here, and then it violently goes lower, and it leaves these bearish fair value gaps, which can be inversed. And this is when you know that the order flow has switched, and that now you're able to run it higher. And this is the trade that I took, and I record. I posted the recording of me taking the trade, and I had audio talking about what I was thinking and explaining on the time. But everything you see here was on my chart as I was recording that. So I did a voiceover after, kind of the best of my ability, talking about what I remembered looking at this trade. But this trade was taken on the 1 minute chart, but I was using the 5 minute chart, the 15-minute chart, and the daily chart to line up with this trade. And I was unsure about holding it to this high. It could just go to 50% equilibrium and then retrace and spend much more time. But this could have been a day trade where I hold it throughout the entire day up to this high. Now, that's not my type of trade. It might be your type of trade. That's you to determine. But you see, like, all this one trade, I was able to bring it down from the higher time frame all the way to the lower time frame, and I was able to get the lower time frame to line up with the higher time frame. So it's all about, when if you have trouble reading anything on the lower time frame, it's about your infancy in price action. You're not using all the different time frames, and that could be because you haven't studied it enough, but it could also be because maybe you have limitations as to what type of trader you are. Maybe you just need more time to think of, okay, what is it that I want to do today. You need more time to figure that out, and you can't make quick decisions, and so you would prefer seeing an order block form slowly on the 5 minute, like this one here, and then or the 15 minute, and then trade back into that, which you might not get that opportunity, but maybe like I don't know, this order block there, right, or something like that. my point is that, of course, it'll depend who you are, but don't try and let's talk about Tuesday, because Tuesday had a hard day, and I lost Tuesday. I lost money. I was trading on the 1 minute chart, and this is a perfect example. Let me go back to this screen, because Tuesday is a perfect example of how I was using the 1 minute chart and finding mistakes. I was making mistakes on it, but I got up and I said we are overextended, but I'll remain on the sidelines until I see willingness to go lower. So here I wanted to see a retracement, and instead of waiting for the retracement like I did on Wednesday, I tried to short it. I was on the 1 minute chart and the 15-second chart, and I kept trying to short it. And even though in this consolidation, and I've done this many times, this is the times that blow my account, when I think it's going to reverse, and then it's just kind of consolidating. It's showing little willingness to reverse, but it's not fully reversing. So when this gap inversed, I went short and got stopped out. Then we created this fair value gap, went short on the limit order, got stopped out, right? But this is all because I was not paying attention to my weekly bias and my daily bias, that we were going to go higher if we trade back to the weekly gap. And instead of waiting for a retracement, I instead tried to get ahead of one. And this, in this condition, is not logical to do, because price is just pressing higher. It's pressing higher until like I said, it's pressing higher until there's no sense of going short anymore, and then that's when it's going to drop. So you want to wait till it drops, and if you go to the 15-minute chart for this day, and you look at that area where I was trying to short in here. What do we see as price is dropping into? As I'm trying to short that candle, it's dropping into a 15-minute bullish fair value gap right after 10. So immediately, why would I want to short that? It's bouncing off a 15-minute bullish fair value gap. Why would I want to short here? I shouldn't want to short there, right? Let me show you that on my trading screen. If I was paying more attention to the 15-minute chart, right, I would have seen that that's the case. I would have seen this 5-minute short-term low after in this consolidation, the whole consolidation back here, all this get taken out, and then I would have had that 15-minute bullish fair value gap bounce, price bounce from it, inverse this fair value gap, or use institutional or entry drill with this small fair value gap there. And as I was taking this trade, I don't think I posted the trade recording because I didn't. I'm gonna watch it over the weekend. I might post it over the weekend, but I was literally saying, as I was taking this short, I saw this 15-minute bullish fair value gap, that short-term low, and the fair value gap there, and I said that, and I even tried to reverse it, but then I said I'm not gonna reverse it. That's stupid. This is my second trade. I don't want to take a third one. It's against my rules, and I'm just gonna let this one play out. And then I let it. I should have closed it, to be honest, but as soon as I thought of reversing, I should have closed it. But I just let it go to my stop. But I was literally thinking of buying this gap as it came down into it because I knew that this was the pattern to my model. But I didn't know. I didn't make logical sense to take this as a long because we were so overextended and we had no manipulation, right? And this lack of attention paid on the higher time frame is what outdid me on this day. So this is how I and a place where I didn't find success on the 1 minute chart, and a time where I did find success on the 1 minute chart. And you can see the things I did to find success and the things I didn't do to find failure on those 1 minute charts on both those days. And you see it's all about reading price action. How are you connecting all these different time frames, all these different ideas? How are you connecting them together? How are they working for you? And that's what it's about. But anyways, with that, I hope that answered the gentleman's question, and that his mind is put to ease. But that's it. And anyone else that watched, maybe you learned something. If you did, that's great. If not, I don't care. quite frankly, I don't care. But I want to remind everyone that I was just answering his question. I don't claim to know that this is the way. I'm still learning myself, and I'm not trying to be an educator. I'm just giving my opinion. That's it.